Welcome to Bar Chart's weekly series of webinars designed to help you, the investor trader, better understand a variety of trading ideas and concepts, as well as the tools and pages that Bar Chart provides to help you to make a more informed investment decision. This week's session, Understanding Option Greeks. Our discussion is going to be about the variable option outputs that help determine a theoretical price for options. A better clarity of the risk imposed by these Greeks on options pricing gives traders a measurement tools that depicts the risk and reward characteristics of an options position or an options profile. Hello, everyone. My name is John Rowland. Welcome. Thanks for being here. So recently, we at Bar Chart have realized that we've been getting a lot of questions about options. And because we've been doing a discussion, whoops, let me get to my, there we go. We've been following these options, summit sessions about following the strategies and the pages that we have. And so what we thought we would do is, before we move forward to some of our more complex option strategies and concepts, that what we would do is we would need to take a half step back and build a foundation of basic information as a jumping off point, so that allow us to tackle these more complex strategies as we move forward. So hence, what are the Greeks and why we decided on doing this particular session, okay? So with me today, as always, is my partner and our moderator, Gene Baker. Hello, Gene.
Hello, John. How are you?
I'm doing just fine, and welcome back. Did you have a restful and enjoyable vacation?
I did.
Good. I'm glad that you're back. I missed you terribly, but I'm glad also that you had a time to unwind. So welcome back, and are you ready to get back to work?
Oh, yeah. Well, I think today you're going to be doing most of the work talking about option Greeks. So go ahead and let's get started, John.
Okay, great. All right, so just remember our disclaimer is that all trading has a form of risk, and options for certainly have a lot of different risks. You can lose not only your principal, but you could be exposed to greater risks. It's important for you to understand these risks before you take on any trading activity. And we at Bar Chart always recommend that you seek the advice of a qualified financial professional, and that you take in considerations the ability to bear these financial risks. And that's the strategies or concepts that we present in our sessions are no indication of future results based on past results. Okay, so just keep those things in mind. All right. Okay, so our goal today is to put down this foundation of who, what, and where. And later this summer, what we'll do is we'll go into the why of these more advanced concepts like delta neutral or gamma scalping or position Vegas and things like that as we go into those more advanced strategies. So today is about the basics, right? What are Greeks and what can we anticipate when we're looking at price based on those different Greeks? Okay, so option prices are broken into two components, right? One is called the intrinsic value, and that refers to the in the money, right? The ITM. How much is our strike price being exceeded by, the stock price exceeds the strike price? How much is it in the money, okay? And then time value premium, right? The portion of the option price that is minus our intrinsic value. Now, some options might have zero intrinsic value. We call those out of the money, OTMs. And what I want you to understand is it's out the time value, right? It is not only about time or time to expiration, but it represents that excess value, right? The longer the time we have, the more factors that will influence our options prices. So what are some of those factors that could influence options prices? Well, the underlying price of the stock, that would be obvious. Our strike price, our time to expiration. Now, let me just pause here for a second. When we talk about time to expiration, or the expiration date, on our website, we're going to talk about DTE, days to expiration. But I also want you to understand that days to expirations will be calculated in calendar days and not in trading days, right? So just be aware of that as well. Okay, volatility of our stocks will have a great impact on influencing our option prices, current risk-free interest rates, and dividends. So we're not going to talk about dividends today. Maybe we'll look into that maybe later on, but we're going to concentrate on these first five or so, okay? And our Greeks, right? Well, they are, well, first of all, let me go back this a second. Notice here that on our 6 factors that influence our price, that 5 of these are factual or absolutes, right? They're real. They're numbers that we can find, right? They're not going to change as we enter into a trade. But one of them is undefined, right? Volatility, right? That's our great unknown. And this is going to be a key moving forward as we talk in our discussion today, that one is going to be one of the harder ones, and also one of the ones that's going to influence our Greeks, okay? So we're going to talk about 5 Greeks today, Delta, Gamma, Theta, Vega, and Rho, but we're really going to concentrate on these 4 ones, these core ones, and they will be the key to pricing and risk management. But notice that, again, I've included volatility, and it's not necessarily a Greek, but certainly an important factor in our discussion today. All right? Okay, cool. All right, delta. All right, so what is delta? So delta is our theoretical estimate of how much our option price is going to change with a change in the price of our stock. In this case, a $1 change, right? Call deltas have what we call a positive value, or a range of values between 0 and 1. Put deltas have negative values, ranges from 0 to -1, right? And the closer an option is, an option's delta is to the value of 1 or -1, the more the price of the option responds to change the price of the underlying. In other words, it acts more like the stock itself. So calls have positive deltas and positive correlations to the stock price, right? A rising stock price, then we will see a rising call delta. If I have a falling stock price, then our call deltas will fall. But puts, on the other hand, have a negative correlation, right? A rising stock price, right? Then our put deltas actually move closer to 0. And a falling stock price, then our deltas, our put deltas, move closer to the value of 1, acting more like the stock. Now, some platforms, like bar chart, express delta in a whole number. So for instance, some platforms will talk about deltas in this 0.50, or will convert it on a 100 multiplier like bar chart does to 50, right? So I just wanted to make you aware of that. So let me go back to my Apple here. And I just went to Apple because it's one of the most largest traded stocks and largest option stocks. And under the options section of Apple, we do see volatility in Greeks. And that's what I've done here, is open that page. And there's our delta right there. And you can see how we at bar chart represent delta in that whole number, right? 48, 53, 59 point whatever, okay? All right. Delta also can represent the approximate probability that an option is going to finish in the money, right? This in the money probability. So if I have a delta of 10, then there's a 10% chance that that strike will finish in the money. If I have a 50 delta, then I have a 50-50 chance. If I have a 90 delta, then I have a 90% chance that that strike will finish in the money. But we can also think about this on the other side of the coin, where if I have a 10 delta, then I am 90% chance that it won't finish in the money. Or if I have a 90% delta, then I have a 10% chance that it won't finish in the money. So this will also help us in some of our strategy concepts. All right. Time has an effect on deltas, right? Same strikes of in the money calls will have, with a longer term to expiration, will always have a lower delta than those of lesser expiration dates, days to expiration. And just the opposite for out of the money calls, right? The longer to time of expiration will have higher deltas than their equivalent strikes of lesser time. So I want you to think about this in terms of extremes, which is kind of cool way to think about Greeks when we start doing our Greek process. Think about it in a big extreme, right? So if I'm looking at a strike of similar value, right? I'm looking, let's say, a $50 stock and a $50 strike, and my option is going to expire. Let's make it really extreme. It's going to expire in the next 50 minutes or next hour or something to that, right? That delta is going to be a lot higher because, or lower, bigger price movements in the delta because we're running out of time. But if I look at a delta of an extreme, let's say a year from now, right, its delta is going to be a lot smaller, right? So let's look at Apple here again. So I'm looking at, here's 134, right about where we are currently, right? And here you can see our delta for a July expiration is 48, right? If I go to a lesser time, one that is going to expire in 2 days, right? I see our 135, 133 delta is a little bit higher, right? So again, that concept of time and price change, as price is in the money, right? How are we going to see those higher or lower deltas? Okay. All right, so let's go back, right? Again, just the opposite for our out of the money calls, right? The longer the time we have, we're going to find higher deltas, right? So again, I'm going back to looking at these strikes that are going to expire in 2 days, right? If they're out of the money, right, farther out of the money, notice that they have very low deltas. If I go to, let's say, a strike whose expiration is, maybe in September, right, and I look at those out of the money deltas, yeah, they're not significantly higher, but they are higher than the deltas of those that are about to expire. Think about it in terms of extremes, all right? A delta can also give us an equivalent position size of our options as it compares to a stock position, right? And we'll use this in delta neutral formulas later in our discussion in our next time we go into a little bit deeper. But think about it like this, for instance. Let's say I have a stock and it rises in price of $1, right? And an options contract represents 100 shares. So if I have 100 shares of a stock and it rises by $1, then the value of my stocks is going to go up by $100. But if I have a call delta that has a delta of, let's say, 50, and I get $1 rise in the stock price, well, my option is going to act like I own 50 shares. So that would translate to a $50 increase in the value of our options. And so this will be important for us when we start talking about delta neutral. And we'll do more discussion of this later when we go into look at our multiple leg strategies. Okay, gamma. Well, let me give you some takeaways in delta first. So delta is how much our price changes with our underlying price change of our stock. And it also can give us that probability of finishing in the money. And as for strategies, right, we also want to realize that the closer the delta moves to those extremes, right, 100 or 0, the more or less sensitive it is to the price of the stock. 100 being more sensitive, 0 being less sensitive. All right. So gamma, what is gamma? Well, gamma is the rate of change in an option's delta with respect to the movement of that stock price. Sometimes it's referred to as delta's delta, right? And it's usually expressed as a change for every 1 point change in our delta, right? In terms of our underlying price. All long options have positive positive gammas. All short options have negative gammas. Now, this is where it can get gamma can be a little confusing, all right? So let's see if I can add some clarity here. So a positive gamma means that the delta of, let's say, a long call, right? I'm long calls, will become more positive as we move towards that delta value of 1 or 100 when the stock price rises, and less positive and move towards 0 when the stock price falls. A positive gamma of a long put, the delta will become more negative and move towards -1 or -100 as the stock price falls, and less negative and move towards 0 when the stock price rises. So for a short call, that would have a negative gamma, and the delta would become more negative to the position as price moves towards that 100, as it becomes more like a stock price. So gammas of long positions are positive and gammas of short positions are negative. And typically we find our gammas are the highest where our deltas are in this range of between 40 and 60. And also those options that are at the money or closer to expiration. Again, if we think about this in terms of our extremes, right? A front month that's about to close, that's at the money, will have more gamma than, let's say, a leap, an option that is going to expire a year or 3 years from now, right? With the same strike, because the delta, right, is moving closer to those extremes, right? It's either going to be in the money or it's going to be out of the money in that shorter period of time, right? So as delta moves closer to 100 or 0, where a leap, we have a long time before that final verdict. Is it going to be in the money or out of the money, all right? Implied volatility can change the effect of our gamma, right? And so as implied volatility decreases, our gammas of our at the money calls and puts will increase. And that might be counterintuitive for some folks. And as implied volatility increases, then the gamma of both our out of the money and in the money puts and calls will decrease. All right, so let's talk about the second point first. All right, think about this again, and that's extremes. A deep in the money option or a far out of the money option, right, already have high or low deltas, right? And so therefore they're going to have lower gammas because they can't move much more until they get closer to that 100 or 0 value. All right. On the second point, on the first point, this occurs because of Low implied volatility options have a more dramatic changes in delta when the stock prices changes, right? A high IV stock will see less of a delta change with a stock price movement because the probability, right, the probability of finishing in the money or out of the money has already been baked in. All right, so let's look at that as an example. All right, so first of all, let's look at our implied volatility here. We have a low implied volatility of Apple. Our implied volatility is around 20 and a half. And let's look at the 134 calls. We're going to just look at that. Let me go back to July. We'll get the 134 calls, and we can see our gamma here, right? And at the money, right, is around 0.05, right? And then applied volatility is 20. But let's go to a stock whose implied volatility is a lot more, much more extreme. GameStop is definitely one of those ones that has been in the news lately. And again, I want to make sure I can do apples to apples in terms of expiration dates. So we're looking at the July monthlies, and our implied volatility here is 140. And our current price is around 215. And if we look at our gamma of our 215 and at the money, notice that it is only 0.005, a lot less than the gamma of our low implied volatility Apple example. Now, some of you might say, well, this could be because, the price value. We'll look at that and when we go into theta. But again, this is where the price has already been baked in. The gamma has already been baked in because of this greater volatility in the game stock. All right. All right. All right. Theta. Theta is our sensitivity of our option as it passes over time. Now, remember, all options are wasting assets, right? Just like a coupon at the grocery store, right? Eventually it expires, right? And again, I'm going to go back to the Greeks in a second here, but usually this is going to be expressed in a one-day event, right? Some platforms do it on a weekly, but most platforms do it on a one day as one day passes, right? And it's also displayed as a negative number to reflect that decay from loss of value as that time passages. Now, for options buyers, right, theta is negative. It's a foe, right? We're fighting time. For option sellers, theta is positive. It's a friend, right? We're appreciating, we're taking in that decay, all right? And in general, again, the higher the implied volatility, the higher the theta value, all right? So again, let's go back to our Apple here, right? And again, let's look at our theta of our Apple, right? Our July, our theta here is only 0.05. But if we go to our theta of GameStop of a higher implied volatility and at the money, right, you can see that our theta is 65 cents or a negative 65.65. Now, some of you might say, well, that's because GameStop is a $220 stock and Apple is a $130 stock. But the price in relationship, Apple is a little bit less than half of the price of GameStop. But our difference in our thetas here is almost 12 or 13 times greater. Again, that implied volatility is going to have an effect on our thetas, okay? Theta or time decay is not linear, right? Theta tends to be gradual at first, right? And then accelerate as we move closer to expiration. Those of you who have been in some of my previous options sessions, know that I advocate this increase or this exponential acceleration really starts to be noticeable inside of about 20 days, although the math will show us that somewhere around 40 days, okay? Again, if I go back to my Greeks, let me go back to Apple. Here we are 23 days out, right? And our thetas at the money is around a little bit more than 5 cents. If I go to a much shorter time frame, right? And again, these options are going to expire in 2 days. My at the money, you can see my theta now is much more. It's minus 21. So, outside of 40 days, theta will be very small. Again, if I go to a time frame outside of 40 days, here's the September's, notice that, we still see a decay, but it's only about 3.5 cents. It's 3.5 cents all the way until we get to about 20 days. And then inside of 20 days, that's when we really start seeing our thetas start to explode. Okay. So one of the things that you can do, and this is important when we start looking at options, is if a day passes and I look at my option price, and let's say I'm inside that 40-day window, and a day passes and my option price doesn't change, it doesn't change by my theta decay, then I know that one of the other variables that we're looking at, one of the Greeks we're going to look at, must have changed. Now, most likely it's probably going to be an increase in implied volatility. If price decreases more than my theta decay, right? It was greater than that perceived theta change. Again, something has changed, right? Someone else has changed. And again, it might be our implied volatility. So this is a good mental exercise for those of us who are learning options, right? At the end of the day, what you can do is look at your theta decay and see if your option decayed greater than or less than what you anticipate. And then looking at the price of the stock, looking at what the stock price did that day, see if you can try to figure out which other Greek maybe influenced your price of your options, right? Again, maybe it could have been volatility, right? Or maybe price moves up and we've got an increased deltas, right? Our gammas increased, our deltas increased, and maybe that delta increase offset the decay of our theta. At the money options have the greatest exposure to time decay, right? That acceleration of decay. And deep out of the money or far out of, deep in the money or far out of the money options have little time decay, as they have little time premium. They're a little bit more linear, right? The decay is more linear at this stage. Now that's because, right, and out of the money or in the money options, again, have these higher deltas, right? And or lower deltas, right? They're closer to 100 or 0. So they're going to also have smaller gammas. And when we look at Vega, they'll have smaller Vegas as well, because they're less impacted by that implied volatility. Okay, again, right? We can see that out of the money or in the money, right? Compared to at the money, our gammas are less, our thetas are less, and our vegas are less on both sides of the spectrum. So strategy-wise, what we can think about is buyers of options, right? Hope that their delta gains, either through gamma or vega, will offset or outpace those losses from theta decay. And option sellers, right, hope that their theta decay will outpace or outgain the risk of delta and gamma and theta gains. All right, so that's kind of where we want to be when we think about theta. All right, Vega. What is Vega? Well, Vega is our sensitivity of our options value as it changes in our volatility. As our volatility increases or decreases, that Vega change is going to affect the price of our options. Now, again, this is usually expressed based on a 1% point change in our implied volatility. And all options, regardless of puts or calls, have positive Vega values. In other words, they become more valuable as volatility rises and less valuable as volatility falls. Longer-term options tend to have higher Vegas than short-term options. Longer-term options are typically more expensive, right? And therefore, a 1% change in implied volatility will represent a greater dollar amount in our premiums. And closer to the money, at the money, will also increase an option's Vega value. Again, if I'm looking at my Apple, right, at the money, right, our Vegas are going to be greater, right? And those that have greater volatility, right, are going to have also those greater Vegas as well, right? So let's go and look at GameStop, right? You can see our Vegas here of our at the monies are closer to 21, where we saw in Apple, it was a lot less. The other thing we can think about in terms of Vega is that this implied volatility will have a greater impact on our options prices than delta, gamma, theta, or even rho combined. And that's an important concept as we move forward here. The other thing I want you to take away from this last point is that Vega and implied volatility can change without any movement in your underlying stock, right? And this is going to be important when we start to evaluate options. We're going to look at our implied volatility and our Vegas to help us determine what might be a better strategy for us to use. So one of the questions I get a lot of times is, and I want to just kind of take another step back here, is under volatility. Is somebody will say, well, what's the difference between historical volatility and implied volatility? So historical volatility is that measurement or that statistical fact of what has been the price range of a stock over the past, right? Not necessarily how far has it moved, but that vibration, that range of price that it's moved in a period of time. And it can be measured over a variety of time frames, right? Giving traders a greater sense of how volatile that stock is. And we'll only use historical volatility as a comparison, right? That's its real purpose, right? Where implied volatility is the market's prediction or that emotional value, right? As more buyers come into the market, right? That will increase volatility. As sellers come in, right? Selling options, that will decrease volatility. So that's that emotion to price, emotion to the market, right? And that's the way the market kind of predicts where we think that range of price is going to move. Now, typically what happens is that emotion, it goes greater than the historical, right? And so that's kind of where our theory of our option strategies are going to be based on this difference between implied volatilities and historical volatilities, all right? So let's go back to to Vegas for a second. all right? So all options have positive Vega values. In other words, they increase when volatility goes up, and they fall or have negative Vegas when the price of the volatility falls. So buying options creates a positive or positive Vega, and selling options creates a negative Vega, right? So if I'm creating a positive Vega, right? Well, when do I want to create a positive Vega strategy? Well, when option premiums are deflated. Now, one of the ways that we can look at options premiums in terms of volatility is something called implied volatility ranks, right? And the theory being here is that price or price of volatility as it reflects through volatility will revert back to the historical volatility mean, right? So we have some tools for you in bar chart that help you do this assessment of implied volatility versus historical. So one of the main pages that we have is our implied volatility rank and percentage. And this page, we've had a webinar about this page. It's sorted based on volume first and then ranking the implied volatility and the historical compared to the historical. So Apple, I like Apple is a good example because it's always one of the highest volume markets, and you can see for today it's right there at the top. But we can see that our implied volatility of an at the money option right now is around 20, and our IV rank, this 20 implied volatility compared to the implied volatility over the last year is around 2.6%. In other words, very low in the range of an implied volatility of Apple. So this would be a candidate for somebody who look for an option strategy where we create positive or positive Vegas, right? Now, we can also go to an individual stock. And let me go back to Apple here. On the price overview page, if it doesn't happen to be on the implied volatility rank and percentage page, you can scroll down here and you can see that under our options overview, we do see our implied volatility, our historical volatility, our percentage, and our rank. So this is where you can find that information. Now, some of you might be very quick to realize that, hey, John, something's wrong here, right? My implied volatility is above my historical. How come it has a low rank? Now, remember, rank is based on the current at the money implied volatility based over a certain period of time. What period of time? 1 year. The overview, right, will give us our implied and historical volatility. Now, just remember our historical volatility here is 16.12, and our implied volatility is 20. The overview page gives us a historical based on a 20-day historical volatility. So that's why we see the implied volatility for Apple today above the options overview historical volatility, because it's only showing us the 20-day volatility, right? If we look at volatility over a longer period of time, notice that here we have the 100-day historical volatility. It's above that 20%. So again, so if I go back to my Greeks page, and at the top of my Greeks page, there's my current at the money implied volatility, and my historical, well, you know now that this represents your 20-day historical implied volatility, okay? All right. Longer term options tend to have, we talked about that, all right. So understanding our implied volatility in a historical sense, right, gives a trader a better understanding if current volatility is relatively high or low, and that would lead us to trading opportunities, all right? All right, let's just briefly talk about Row. Actually, and the Row is one of the deltas, excuse me, one of the, excuse me, senior moment, one of the Greeks that really has, at this point, has very little impact on most of the options that we're going to be looking at, unless you are trading longer term options. So it's a sensitivity of the theoretical value based on the interest rate change, right? And expressed in a change of 1% of an interest rate change, right? So really all I want you to understand is that Rho is positive for calls in higher interest rate environments, and Rho is negative for puts in higher interest rates environments. And this comes down to the cost of money or the hedging factor or the cost to carry, however you want to define it, right? So if we think about what has been happening over the, let's say, the last few years, short-term rates, interest rates have been negligible, right? I mean, around zero or for a long period of time. And so it really only impacts those options that have a long exposure to a potential change in interest rates, those leaps, those long, extended options, years, 2 years, 3 years, whatever. But, moving forward in time, as we start talking about the Fed, and if the Fed starts moving towards to raise interest rates, then that will make the cost of money more expensive, right? That hedge factor, and which means that calls will become more expensive. So just that's the takeaway I want you to say. It's really just for longer term, but in the future, if interest rates start to rise, that is going to make all calls more expensive. Okay. All right. So what are some plans of action, right? So we got a basic idea of what is going on with our Greeks, right? So what can be a plan of action? What option strategy will I use? Now, again, there's no right or wrong strategy. There's no right or wrong strategy as far as I'm concerned. If you put 100 options traders in a room and you showed them all of these 6 different influencing factors or the different 5 different Greeks, you'd probably get 1,000 different strategies, right? So there's not one right or wrong. I just want to give you guys a little bit of food for thought, how to kind of like break down, some of this information that we just put forth. All right, so the first thing I'm going to start thinking about is my trend analysis. What's our current trend? Do I believe it's going to continue, right? Is my trend going to continue to go up or down? Is it going to slow down, right? Maybe consolidate, or is it going to change, right? Is my trend coming into a place where I feel like there's support or resistance, where it's going to change that trend, right? So one of the main differences between, let's say, stock ownership or trading futures contracts is, in order for us to be right, we have to pick the right direction, right? We have to pick which way we think the market is going to go. But what's cool about options is that it allows us opportunities to pick the direction, one of the directions that we don't think it's going to go. And that's a lot easier to do, right? I might look at a stock and say, hey, I feel like this stock is either going to hold value or go up, but I don't think it's going to go down. So I could create a strategy based on that. I could say, hey, if I don't think that price is going to go down, then I could look at a strategy which would take advantage of. For instance, maybe a bull put scenario, something to that effect. Okay. What is my anticipated price action, right? Is my price going to change? Is it going to get more volatile? Is it going to become subdued, right? Now, not necessarily the direction, but really that action, right? That vibration, right? Am I thinking that volatility is going to increase or decrease? Is there a catalyst, right? Is there some kind of catalyst, like for instance, an earnings report that could give me an anticipated price action. Or maybe, I'm looking at a chart and I'm breaking through an area of resistance, or I'm making a new all-time high, or I'm falling through an area of support. That could be in a catalyst of price movement. And so then what I can start thinking about is these positive and negative correlations that our Greeks provide for us if I have the benefits or the risks of the different price actions, right? What will my Greeks correlations be, right? For instance, let's say I think I got an earnings report coming on, and I think that it's going to propel the price of the stock higher, right? So I want a strategy where I'm going to have positive deltas, right? I want to have positive gammas, right? I'm going to be buying options most likely. And I'm probably going to be fighting Vega. I don't know what my implied volatility is going to do. No, typically what we see is that implied volatility rises as we get into an earnings report. And then typically after the earnings report comes out, we usually see implied volatility fall. And then my theta, right? What is my decay? Is my gamma and delta going to outpace my theta decay? So maybe I might want to purchase more time, right? Where my theta is not as large than, let's say, one that is closer to expiration. And typically I see this, I get questions like folks to say, hey, I thought the stock was going to go up, and I got a positive earning report, and it went up 7-8%, and I had a call that was out of the money, and now it's in the money, and I didn't make any money, and actually the option actually is worth less. Well, you picked a strike that is farther away from current price, right? Out of the money, smaller delta, right? Smaller gamma. And you maybe picked an option that is going to expire in a shorter period of time. So you are fighting that theta decay. So that could be one of the reasons why. Or also, your implied volatility could have fallen. So all those things went against you, even though you got the right price prediction. So we want to gauge implied volatility, right? This is going to help us in our strategy discussion, right? So again, we talked about rank and percentage, right? And so, yeah, there's a lot of strategies out here. I just wanted to kind of make this very simple for you guys. Just kind of think of it in big picture, right? So if I'm looking at a stock and it has a low ranking, implied volatility, low ranking, maybe I just look at doing a single leg, buying a call or buying some puts. If I feel that I'm coming into an environment where my implied volatility is starting to rise, or my stock is starting to move, be it up or down, or just starting to vibrate, right? It's starting to get a little bit more volatile, right? Then I could look at, bull calls or bear put strategies, or I could look to buy a straddle, right? If I'm thinking I'm coming into a falling implied volatility environment, then maybe I'll do some bear calls or bull put strategies. Or again, I could maybe do a strangle, maybe sell a strangle, try to capture as the market comes into a low implied volatility environment from a high implied value. Yeah, could I also sell straddles? Yeah, I could do that as well. I'm just trying to keep it simple here. And if I'm in an inflated implied volatility environment, then yeah, I might look at, again, some bear call or bull put strategies where I'm going to try to capture those premiums. And I could do a combination of together and create something called an iron condor, a short iron condor. So as I do my analysis, as I do my price appreciation or anticipation, as I look at my implied volatility and I look at those factors, then I can start thinking about what strikes I want to choose, which strikes are going to benefit, right? Which, based on my Greeks, are going to help those strategies, which strikes or which Greeks are going to be risks for me, right? So we have something called moneyness, right? And so if we go back to our Apple example, one of the cool little features we have is that on a lot of the options pages, you will see moneyness. And moneyness is basically just telling you how far you are in the money or how far you are out of the money. Now, one of the questions I always get is, how do you determine what is at the money, right? So a lot of folks will say, well, you know, what would you define as at the money, right? Because strikes are static, but price is always moving, right? So, you know, some folks, some traders will say, you know, if you're in within 5%, or if you have a more volatile market, you know, you might say 5% of current price. I tend to use a matrix of average true range, or ATR. I look at like, what is my 1-day average true range as I'm looking to set a trade. That would tell me that I'm probably a little bit closer to at the money. But remember, we talked about deltas, right? We talked about at the money deltas between 40 and 60, right? That's kind of where we want to be when we're in or at the money. So if I look at, let's say, Apple here, for instance, the 1-day ATR for Apple is around, excuse me, the 20-day ATR for Apple is around $2.30. You can go look in technical analysis and it's in there. And let me go back to Greeks. So $2.30, that's going to be my at the money range. So current price is around 133. Let's round it up. Let's say 133.80, 134. So $2.30 or so. So, you know, $2 above or $2 below, you know, 134 would be at the money. And if I look at my deltas, right, and I'm at 134 and I go down $2 or $2.50, right, my deltas, let's go to them, excuse me, I'm not going to look at the ones that are expiring today or tomorrow, Friday. You can see that we stay in that kind of that 60-40 range. That's kind of where you want to be if you want to be at the money. You want to be in that 60-40 delta range, right? If I did 5% of a $134 stock, you know, that's almost $6-7. Notice that if I go $6 or $7 away from current price, now my deltas are getting outside of that 60-40. So that's one way you can do it. You can either do it based on the moneyness, or you can do it based on this ATR versus your that 60-40 delta. All right. The other cool thing that bar chart does for us is we'll take all those variables, all those Greek variables, and compile them together, and we'll give you a theoretical value. And you can see that is what is here, okay? And we talked about low IVs or high IVs in terms of setting a strategy, but when you go to put your price in and put your bid or your ask in, which is nice about the theoretical value is it tells you what that option is worth. So you can set your bid or your ask close to that theoretical value. Or if you're looking at price at the time, now let me see if I can see an example here, right? For instance, here the 128 last traded 644. Now that could have traded 644 a while ago and prices moved, and that's why the theoretical value has gone up. But it's telling us that that price is less than the theoretical value. So that could be telling us that somebody is selling that option, or if we see that the last price is above the theoretical, that could be telling us that that emotional buying is pushing that price up. Okay. All right. So how are my Greeks going to respond based on the moneyness? Am I at the money? Am I in the money? And or am I at the out of the money? What benefits do I want to try to achieve? What rewards I want to try to capture? And what risks do I need to be aware of those Greeks? Okay. All right, so I hope this kind of helped you guys a little bit, give you kind of just a basic understanding of what our Greeks are doing at different times, at different placements, and current price versus our strike prices, and things to kind of look for, right? This plan of action, right? How we anticipate price, what we want to try to capture, and just some basic strategies. So I do see a lot of questions here. Let me see if I can answer a few questions before our time is up together. Gene, is there any one or two questions that stands out or kind of a common theme here?
Well, let's see. A lot of people are asking if this is being recorded, and yes, you are going to get a link to the recording a little bit later on today. A number of other people have asked if we are making your slides available, and yes, those will also be sent along to you with the link to the recording a little bit later on this afternoon. A lot of very specific questions that I'm sending your way, John, so I'm hoping maybe you can take a moment and scan through those. Some of these questions may be a little bit too complicated to go through in the time that we've got remaining here. So if you don't have your question answered, please email our support group. It's support@barchart.com. They'll be happy to help you through with whatever questions you have.
Yeah, and I would definitely listen, folks. If I don't get to your questions today, I would really, really, really advocate to you that take that time to go and on the main page at the bottom here, contact bar chart, this little blue button there. Take that time to put the question in there, right? We have a really great staff. A lot of the guys that are on the support staff are options traders, and their knowledge far exceeds my knowledge, and they will help you out with something that you might be struggling with, or especially if you don't understand some of the concepts or how to use the bar chart tools and pages. So I really implore you, please, please, don't get upset that I didn't answer your question, and take advantage of our support staff. So here's a good question from Victor, who says, well, if you're going to create a predictive model, how would you weigh each of the Greeks? Which one would be the most important in the ranking, right? And would you sort them based by, and he says here, by expiration date, delta, gamma, theta, etc. So Victor, again, I think there's a couple things I would look for. First of all, obviously, volatility, I've showed you here, has the greatest impact on options prices. So that's really kind of where I would be starting. But if I was going to pick of the 5 Greeks that are out there, obviously Rho not being that important, right? If I could only look at one, well, I'd probably look at gamma, right? Because gamma kind of really gives me a lot of information, right? If I'm positive gamma, then I know that I bought options. If I bought options, then I know I'm either probably long calls or puts, and that I'm probably also long delta, right? And if I'm long deltas, then I'm probably also at some kind of a risk exposure to theta. So I think in terms of importance, in terms of influencing, yeah, I would say, volatility, and then maybe Vega as that change in volatility. But I think gamma kind of gives me a lot of information, right? I like that one, right? By the way, like Gene says, a lot of very, very, very specific questions and detailed questions.
Right.
Right.
Some of you are sending us paragraphs of questions that you would like John to answer, and we're going to try our best. But as I said, as John said, email support, they'll be able to.
Yeah, Timothy,
to help you
your gamma question again. That will probably be something that we'll tackle when we go in deeper into the weeds in our Greeks 2.0 session. All right, so this is kind of an interesting question. Shin asks, can you explain once more what is considered a delta gain? Right? Does gain equal increase a numerical value, or does it equal a competitiveness for contracts for either buyers or sellers? So delta gain would be, as price moves, the option moves with sensitivity, greater sensitivity or lesser sensitivity in terms of gain, delta gain, more sensitive to the stock. Now, what could create a greater delta, right? Could be volatility, right? Volatility, right? What could increase implied volatility? Well, that would be, that emotional aspect of people buying and selling. So really, delta gain is the change in our delta as price starts to move from either at the money to in the money, right? That would give us greater delta gains. But what could acelerate that delta gain could be as you say, that competitiveness or that implied volatility aspect of our options, okay? All right, so Timothy asked another question about historical. He says, when you started the discussion about historical, I thought bar chart is a great price history feature. Thank you, Timmy. I do too. Can you say a bit about this feature set and the comparative analysis that you can do through those screens? Again, yeah, you can go into any one of our option screeners or even the stock screeners, and you can pull up your implied volatility and your historical. And again, when I'm looking for certain strategies, for instance, like in the straddle segment we did a few weeks ago, I want to see a rising implied volatility compared to my historical, but I still want to see a low rank, but maybe not, below 10%. Maybe I want to see it starting to get into that 10, 15, 20, 30%, right? As my volatility starts to rise, right? So yeah, there's a great feature inside of stocks. Well, so let's go back to our screeners. For instance, if I'm doing long straddles, I think this is what Timothy is asking, right? I can come into the filter here and filter based on my implied volatility, my average volatility, my 3-month, 6-month, right? 1 year, right? And here's my historical, Timmy. So you can put those two together on your filter screen to look for it. And let me just see if I have that done for you guys already in my previous sessions. I think I do. So I want to go to my long straddle screener. Yeah, so there's what I think Timothy is asking, right? So here's my IV rank, here's my 1 month implied volatility, right? I want to see that in the last month, my 1 month implied volatility is rising, right? And how does that compare to, let's say, my more historical implied volatility, or is my ranking starting to move up? So great question there, Tim. Hopefully that asks. Yeah, Brian, Dan, we're not going to talk about positive negative skews right now. We'll look at that next time. All right, so Aaron's asking about this correlation between the VIX and options. Again, Aaron, I think that's really kind of a specific question, but I would say to you is, kind of VIX is the market's look at volatility, right? So you can use that as a gauge of a broader sense, right? So if you are seeing the VIX at a low volatility or a low VIX value, that could give you a sense that the broader market, that you're going to find lower volatilities in all your individual stocks. Now that, each stock is different and every one is in case, but again, maybe you could think about the larger cap ones or the ones that are more actively trading. So for instance, VIX is really low and you look at our Apple, one of them heavily traded stocks, its implied volatility is low. So I would look at it in that sense, okay? All right. Oh, so we're at the top of the hour. All right. So if I didn't get to your question, I apologize. Again, please send them along. As Gene had mentioned, this will be recorded. You will find the recording, either get an email or you can come back and listen to this again in our free webinar session. And this will be found under the options session, right? Understanding options Greeks. That'll be up sometime later today, right, Gene?
That's correct. We also are going to include the slides that John showed you today for your reference. A number of people asked about that. And let's talk a little bit about our next session. There's nothing posted there again in that blue box at the top of our webinar archive page.
Yeah, so Gene got last week off, and I'm going to get the next 2 weeks off for summer vacation. So I'm going to take a little time off, refresh, get my trader head back on. I'm a little burnt out from the last 6 months, so I'm looking forward to my time off. I'm actually coming out to Chicago to meet the staff. I'm going to get to meet Gene, so I'm really excited about that. But when we come back, I think I can kind of hint about this. Can I, Gene?
Oh,
When we come back?
absolutely. Let's talk about what we're going to cover next time.
Yeah, so we're going to tease. When we come back in July, on July 14th, we're going to look at candlesticks. And Gene has been really, really working hard with me, and we've got some really cool features that we've put onto the website about using candlesticks. So we're going to look at that. Then on the 21st, we're going to go into some technical analysis. We're going to look at RSIs versus stochastics. And then throughout the end of July and August, we'll have subjects in terms of looking at top picks. We'll come back to our complex strategies, our short strangles, and we'll look at different charts sometime in August, different charts, and see what we can learn from that. So those are some of the ones that are coming up. So I would recommend that what we can do is make sure that if you want to be notified of when our segment's going, submit your your email, you'll get a notice, or just come back to the website every once in a while and check out and see when that is. Would that be good advice, Gene?
Absolutely.
All right, and so finally, before we leave today, I want to say, there is a way for you to try out a lot of the cool features that are on the page, the website, and I would encourage you guys to try the free membership. Anybody can get a public free membership, but to get to the premiums, you can actually have a 1-month trial period. And I think once you try some of these features, these premium features, I think they will sell themselves. So I'm hoping that you guys will take advantage of that opportunity. Until then, I want to again thank you, Gene, for making for a great session. I want to give a shout out to my man Brandon, who helped me with my slides. And I want to wish everyone stay safe out there, be healthy, and the best of all trading.